It's that time of the week again. We have another episode of the Contacts to Contracts podcast. I am Bryan Lovell with my co-host here, John Jones, and we have a huge guest with us today, Mr. Doug Swan from Sarma Credit Services. Doug, I was thinking, preparing for this, I believe we've known each other for about 12 years.
That's probably right. I was even thinking maybe a little longer, but that's probably 12 years. But the huge guest, that was a little scary to start with. Was that a diss or what? That's not a diss. But yeah, it's probably been at least 10, 12 years. So
huge
yeah.
as in you're going to add
you want to say right
value.
You want to say right back B-Love.
Ditto.
So Doug and Sarma are obviously a huge partner of ours. Obviously a very good partner if we've had a working relationship as long as we have. And so you can guess if we've got somebody from the credit side of things with us today on the podcast, kind of what we're talking about. And, I think that credit is one of those topics that people have a lot of questions about in general anyway. But I think in today's current COVID environment, there's a lot of questions specifically about forbearance. So I just kind of figured we would jump into some of those. But before we get started, you kind of want to introduce yourself and Sarma to us a little bit?
I appreciate it. And I'm Doug Swan, and I've been with Sarma, and there's still probably a lot of people out there with VanDyk. What is Sarma? Who's Sarma? San Antonio Retail Merchants Association. So I usually give out a $25 gift certificate if anybody knows, but I haven't given out yet. So
I'm writing that down now
Because I would not have won that.
right.
I know how to get my next meal paid for.
So I've had a free Buffalo Wild Wings for quite a while now. But anyway, so we've been around. Some may even known us. I was with Network Credit before. We got bought out by Sarma, so that's how we came in a relationship with them. And that's about the time you were over at
Tri-County
Mortgage,
yeah. And Laura Lynn, Wanda, yourself, a few others. And I was like, ooh, man, now everyone's, going to this new place. And it's like, I had some of their business already. So, man, that's not good. Well, here we are 10 years later. Number one client's been very good. So it has been a really good relationship. So I've been doing this. I've been in this business now for 30 years.
Wow.
So, of course, means I'm a little older, but that's all right. So enjoy it. VanDyk is, like you said, a great relationship, one of my top clients, and we try to do everything we can. And you help out with it as well, so it goes great both ways. It's been a great relationship.
Yeah. So what are some of the services that you guys offer? I mean, obviously, we use you to do mortgage credit pools.
Right.
But I'm sure that's not the only thing that you guys
That's
do.
a good question, because most of the people think that's all there is out there is just the mortgage credit pool. But yeah, we have all the other products that all the other credit vendors out there as well have. We have flood reports, life of loan. We have AVM model valuations, tax return verifications, employment reports. We also have a collection division.
Wow.
And we have a tenant screening division. So we actually have a whole realm of things that you, if you ever need, we could definitely, get it for you. And I know that, others use others, but we have it available for everyone out there and all of our clients. So.
Yeah. You made me think of a question that I didn't think of prior to sitting down, but is there a difference between a mortgage credit pool and some other credit pool? So we get that, well, I pulled my credit at blah, 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 and it was 700, and why is it 620 here?
That's a great question.
What's the story with that?
I get that about, I probably get 4 or 5 calls a week on that.
Wow.
What you're talking about is people are getting like a Credit Karma, or you can get a free copy of your credit report from any of the bureaus once a year, and those are called consumer credit reports. Those reports are different than the mortgage credit report. And the reason is because they all have a certain score, model score that they have. And the mortgage industry can only use the mortgage model scores. And they have what they call scorecards, and that's how they come up with all the characteristics to come up with the score. Okay. So they have more emphasis on some things in the mortgage division. There's a finance model. There's a automobile model. But the consumer model has their own model, and almost always, as you probably heard, the scores are always going to be higher. I've seen it up to 80 to 100 points higher.
Wow, on the consumer credit report.
Consumer credit report. So, like I tell everybody, it's always good to get a copy of your credit report, and this is what I tell realtors as well, because you want to know. Well, first of all, for the client or borrower, because they want to know what's on their credit report and if it's true or not. So they want to see if it's in there. Is that actually my trade lines? Is there anything that's not, shouldn't be in there that we should try to get deleted, whatever, even though they'll get a different kind of score than you would for the mortgage. And they would share that with the realtor, because at that point, the realtor wants to know, hey, do I want to take my time to take these people around for the next 5 weekends or something when they may not get approved to even get a mortgage? So I always tell the realtors as well when I'm talking to them, and I speak usually for the mortgage brokers or lenders like yourself, is they should try to get a credit report from VanDyk, because that would be the true score, and they know where they stand at. And now where I know that they really stand at, do I want to go out with them? It looks good, but we can have a lot of time now to get their scores higher or for better rates or whatever. So
yeah, that's pretty interesting that you say that, because I can see where an agent or even a borrower might want to take a shortcut in going ahead and get pre-approved by a lender before going to look at homes,
right?
Because hey, I already pulled my free credit,
that's right,
from freecreditreport.com or whatever. Here it is, and the agent's like, oh, you know what? Okay, I'll take you out with that in mind, and then, you go under contract and you get bit.
Yeah, Credit Karma has a 700 score, and you're going out thinking I can get them this house or something like that. Now everything in there is going to be usually the same thing in one report and on the other, like the mortgage compared to the consumer. So it's all going to be in there, but it's going to be different scores, like I say. But until you can get it to a mortgage industry to look at that credit report, you really don't know where you're going to be at. So that's always good to always get, like I always tell them, and when I talk to your branches and different things, make sure that you're pulling it through VanDyk or whatever as soon as you can to see where you actually stand at. But that's a great question, because I get 4 or 5 of those a week, that's for sure. Going, that's
one of those things
score.
You wish you just had an automated recording. If you're calling to ask me about XYZ, hit 1.
That's it. Yeah, that's exactly right. So it's usually Sarma did this to my report. But
anyway. Let me jump in. How often do you get the request that somebody wants to try to rescore to qualify for a mortgage?
Well, that usually comes in once it goes to one of your loan officers, and they start looking to see, hey, first of all, we can't get them approved for anything without getting their scores higher.
Sure.
Or, hey, we can get you a better rate by getting them to a certain score. And the thing is, and we can get into it, now or even a little later, is on our credit report we have a page called the Credit Assure Cover page. So right away, your loan officers can see what the scores are, but they can see exactly how high those scores can go up. It doesn't tell them what they need to do, but it tells them, hey, it can get to a 700 or 720. And right away, your loan officer knowing, hey, I can do a conventional, whatever they need to do. This is what we can do. Okay, let's start looking at simulators, which we have, and I help out in the service of those with all your LOs. How can you get the scores higher? You go in and it tells you exactly if they pay this visa down or this down, it will go up 52 points to 700. So they know exactly where they need to be at that point, so we can help them.
Yeah, John, I think that's a worthy thing to bring up the way you did, because I think a lot of loan officers may not know, if you don't understand loan level price adjustments on
every
interest
20
rates,
points.
Yeah, if you don't understand loan level price adjustments on interest rates, you don't know that doing a rescore for your borrower could benefit them
substantially
by helping improve their rate. And I think a lot of people, the misconception is we use the credit rescore just to get them to a qualifying score. Right. It's, I currently don't have a qualifying score. If I rescore now, I have one. Boom, I'm in pay dirt. But a loan officer who truly understands how loan level price adjustments work on interest rate pricing knows that, hey, if my borrower's at a 700 and I can get them to a 740, I've probably been able to get them a much better rate.
Right?
Yes,
so,
correct.
Which could lead to a referral or something like that by saving them people money. And they go, hey, if you did this for me, who can I do it for?
Yeah, you're 100% right.
But it could even, you can find out, it may take $50 to get to where you need to be.
Right.
But we have those tools that are available for you to check that out. It may take $5,000, but it could be $50. But without those tools, you wouldn't know.
Yep.
So that's something we have available for every loan officer, so they can come and talk to them about it.
Yeah, that's awesome.
I think the bottom line here is pay your bills on time, no matter how big, how small. Right?
Well, that's true.
As the consumer, I mean, one of the lessons you want to teach your children, even when they start out, a lot of kids make the mistake when they go into college and they're offered a credit card and may only have a small amount that they can charge, but the minimum payment may be $25, and they just don't pay it. You know, and they don't realize the impact that missed payment travels with them essentially
Sure.
for life.
Sure.
With whatever they look to do or finance, whether it's a mortgage, buying a car, potentially insurance. Industry-wide, it can potentially cost you thousands of dollars.
Yeah, John, I think one of the things as an originator I've seen consumers get into trouble with is they open up multiple lines of credit. So it's not just the Visa credit card. They've also got the ExxonMobil credit card and the Best Buy credit card and the Costco credit card and on and on and on. And in your mind, you're like, well, it's only a minimum of a $100 a month payment. We'll stack that up on 5 of those credit cards, and those 5 are equal to like a Mercedes payment.
Right. And it's hard to manage.
Yes.
I mean, when you start getting more than 2 or 3 cards every month, and you're tracking whether you or your significant other, did you pay the 7 cards that we have every month, even though they're only $20 each, right? Inevitably you miss 1 or 2, or one you just miss it.
Yeah.
Well, here's another thing about the reports. We're talking about the difference between maybe a consumer report or a mortgage report is all consumer reports, if you have anything on that credit report at all, you're going to get a score.
Okay.
So I probably get a lot of questions as well as I pulled a Sarma credit report, mortgage report. I didn't get any scores. What's up? Well, for a mortgage credit report, there's a few requisites that you have to have, okay, requirements. One, you have to have at least 1 open trade line. So they may have a bunch of trade lines, but they may have all been closed. Maybe they went into bankruptcy, whatever the reason was. So the other one is you have to have at least 1 open trade line that has to have at least 6 months of history. And you talked about a young person, opening up. So, hey, this person has a credit card, 2 credit cards, but he's not getting a score. Well, they've only had 3 months of history so far on that credit card. So you have to have at least one that has 6 months of history. And the last one is, now that we're talking about it, one has to be updated in the last 6 months.
Okay.
So if you've had one and you're like, wait a minute,
you've got to have activity.
Yeah. So if you have activity but it hasn't been updated in the last 6 months, then you can't have a score either.
Okay.
So you're going to have a lot of them that's going to be like that. So we can help you out with that. We can talk about authorized users, different things to get you back on board. But so younger kids, you're wondering why they may not have scores. That's why it'd be in the mortgage industry. So that's what you have to have.
Yeah.
So
cool.
That's something else out there.
What would you say, and you may have already answered this, if you have, that's fine. What would you say is the number one question that you get in your business, whether it's from a consumer, a mortgage professional, a real estate professional? What would you say is the number one?
The first one was probably that consumer report we talked about.
That's kind of what I thought.
The second one is, what would I need to look at or pay down to make sure my scores go higher if I'm going to use my money to do something with?
Right.
So on your credit reports, you have revolving credit reports. Trade lines, then you have installment trade lines. So mortgages, collections. So paying off installment trade lines, if you got your mortgage, you got your student loans, you have your cars, paying those off or down usually does nothing to your score whatsoever. As sad as that is, it doesn't make a lot of sense, does it?
That's interesting.
Not always, but I'd say probably 95% of the time, nothing.
Wow.
But it's your revolving credit cards that paying them down will get your scores higher.
Okay.
So do you pay them all down to 0? No, that's even not good. So it's always good to have at least 1 or 2 open trade lines with a smaller balance, and you'll have a higher score on top of that. But so that's why you need to get with, loan officers and with VanDyk, so they can look at these simulators, and you're not paying thousands of dollars towards something that's not going to help you whatsoever.
Yeah.
So they can help you with, exactly which cards to pay down.
Yeah.
So that's probably the biggest question, is what they need to do to get that score higher.
All right. Fabulous. Fabulous.
Yeah.
Now, I mean, just touching on that, so if somebody has, 3 revolving accounts and they're maxed out, how does that impact compared to somebody that I know the threshold is ideally about 20% of the carry balance? So just touch on how that impacts. And
Just based on that, with that
changes.
Revolving, anything, you want to have a 2 to 3, probably 30% or less. And if you have more than that or higher percentages, your score is probably going to be lower than it can be.
Mm-hmm.
So, well, which ones do I pay? Well, that's when we're going to have to take a look at that for you.
Sure.
And we can help you with that, or your loan officers are well versed in that. So they can tell you what you would have to do exactly, almost down to the dollar, to get you to that score. Because you're like, well, if I just pay this or this, well, you may miss it by $5 and your score doesn't go up or down a point or two. But if you get to this exact number that we tell you, that the simulators tell you, I mean, you could be 30, 40 different points. So
wow.
Yeah.
So that's a big difference.
And to segue into something else, so we pull 3 credit bureaus, and how is it that we see, or a consumer may ask, how is it that we see 3 drastically or 2 similar scores and one that may be drastically higher or lower?
That's a good question too, and that happens a lot. So what usually happens on something like that is all the major accounts, usually all the bureaus have, and they usually get almost to the same day they get adjusted, because it's usually one billing cycle a month where they go through. So, but it's usually a small, I'm not going to say small, but different collection companies don't report to all 3 bureaus. So if you have a perfect credit report, but you have just one collection, doesn't matter if it's $20 or $2,000 or $20,000, it's how many and how recent they are, that score can go down by 100 points easily. And it happens a lot. So, and then they go, well, I'm just going to pay this down to 0. I'll be right back to where we are. Collections don't work that way. If you pay down collections, almost always, it will never improve your score. We could try to tell you how maybe we can get with a collection company, maybe they can do something for you, but that's something we can talk about.
So, I mean, that's just jumping in. That's a lesson for folks out there. I mean, $20 to $2,000. The dollar amount doesn't matter. It hits you the same. I mean, it's tough to swallow.
Well, I mean, I think the part that's tough to swallow on the collection is that paying it down actually could hurt your score.
That's true.
Yes,
right.
That's
and
true.
Doug, I've always understood, and correct me if I'm wrong, but the reason for that is it makes that collection now
newer.
They call it more recent. You're right.
Yeah, more recent in terms of the score. So I mean, that's kind of not so great for the collection companies.
Let the old dog die.
It's kind of not so great for the collection companies, because I understand their purpose in putting a collection on your credit report. But after a period of time, if they haven't collected on that debt, the consumer is better off never paying
That's
that debt.
absolutely. I tell people all the time that if I'm helping them with the scores, now this collection, maybe we can ask them if they'll delete it if you pay them, and that could always help out. We can let you know that. But paying it's not going to help. But let's try and see if they'll help get it deleted. But if not, let's use your money toward some revolving balances if you can get the same product or whatever, the mortgage company, to get the same rate or whatever. Leave that collection alone till later. I mean, you don't need to pay that. Let's look at something that can help. And it's not just collections. It can be, I had one the other day where someone said, I was talking to a group and they're like, well, I had one, they had called me before I went out there and I looked at it, and they paid off a mortgage, $300,000 mortgage, and they had a little bit of a old Sears account that had a balance on it, and it also just went 30 days late.
Wow.
So they paid off $300,000 mortgage, but the late cost them 120 points.
It's crazy.
So we worked on maybe getting that late deleted, but just even, if the late wasn't on there, if we'd have paid down that Sears from like $300 to $10, that score was going to go up just 50 points itself.
Wow.
By paying $200, yet they just paid a $300,000 mortgage off.
Yeah, they'd have been better off paying off the Sears and keeping the balance on the mortgage for another month or whatever.
Just to make sure. So it doesn't matter how much it is. It's really how recent and how many you have of the lates or 30-day lates on a trade line. That's really where you get hit hard. Especially if you have a great credit report before. Now, if you're in the 500s and you have another late, it's not going to affect it so much. But if you have an 800, I mean, I've seen it go down to 680, 690, and people just lose it at that
Shoot,
point.
it's interesting, and I think, again, I didn't necessarily have this as part of my thoughts when we sat down with Doug here, but the other thing I'm thinking about is like, how big of a deal are student loans right now?
Wow. You see more and more and more of them, and they're going into that forbearance as well. So a lot of those people are, I see.
Wait a minute, what's that word? Yeah. Say that again. Did we shift gears into Is there an F word being said here?
4-letter word is exactly right.
In our industry, we don't like to hear that.
No,
it's never good. But go ahead and talk about
more
it.
And more, it's people just have so many student loans that are so high. The how much they owe now these days. I don't know how they're ever going to pay them off anyway.
Yeah, I think it's the next big thing in consumer debt. It's the next bubble to burst in consumer debt.
It's
crazy. Student loans.
But those are we're having to make sure those are in forbearance or starting to be paid or whatever, just to get those through to get approval through the mortgage system now as well. Those student loans, but hundreds of thousands I've seen on one credit report now. They may be in a doctor, maybe they're just living it up. I don't know. But it was crazy.
I know on the student loans, there are certain allowances for putting those in deferment status. How does the deferment status affect?
The deferment it's basically the same. If they put them in deferment status and they can't make them late, however, the balances are still going to be there for what they owe. So a lot of times we'll get called if they don't see a balance. They have to have it. I don't know if it's through DU or the mortgage company wants to see it or something. So we have to come up with a figure for a monthly figure a lot of times for that. So they want to see how much they're paying on each one of those. That's for sure. Because like I said, there's so many that it's you were talking earlier. How many
you have to
end up being like a house payment almost when you add them up. So it's getting crazy out there.
So I think the big news of the day right now is what we just said, that F word. So the big F word is that forbearance word, and as part of the CARES Act that came out, and I believe it was April. Right. It provided a provision for homeowners to put their mortgage in forbearance.
Right.
Which means you don't have to make your mortgage payment for a period of time.
Right.
I think the unanswered question that a lot of people have, and we might even be able to answer it here, is one, how is that going to affect credit scores? But two, how are mortgage companies going to handle forbearance down the road? Is this going to be a derogatory event like a foreclosure or a deed in lieu?
That's a good question, and I don't even know if I know all the answers to that yet, and maybe each lender decides on their own. I'm not exactly sure about that.
And that seems to be what's going to happen. The CARES Act protects Fannie and Freddie, and there's several lenders. That's about 50% of all mortgaged homes. So those folks outside that, they're dealing with forbearance, but not necessarily falling under the CARES Act.
Right.
So they're up for potentially whatever that lender decides to report or negotiate.
But that CARES Act, like you said, it started out where, it was, okay, are they even going to show late? Is it always going to be current? Well, they decided, hey, we can't show it as late if they're in the CARES Act and forbearance. So, but then it was like when I first started, it was like just something brand new, just like for you, I'm sure. It was like, is it going to be 30, 60? Then I saw 90 days, and it could be up to 6 months, and then it was up to a year.
Months,
and then wait, once it balloons, are they going to have to make all that money right up or what? I think most people ended up where they put it at the end of the loan. You could probably tell me more about that if that's what you're hearing.
Yeah, I think that every lender or servicer, it's really the servicer, not so much the lender, they're making their own decisions on that. Ultimately, I think what the consumer needs to understand is forbearance isn't a free ride.
Right.
You have to make that mortgage payment at some point.
Right.
And it could be, to your point, Doug, hey, if I was on forbearance for 3 months, do I have, then 3 months that I have to make double payments to get it caught up? Right. Can I stack it onto the end of the loan?
Yeah.
Can we work out some sort of payment plan?
Right.
I think every servicer is handling that different. I think where it got kind of crazy was in the past, like here in Florida especially, we're familiar with forbearance because we've come across forbearance opportunities because of natural disasters like hurricanes. Mm-hmm. But typically you have to be able to prove your hardship because of that natural disaster. With the CARES Act, you didn't have to prove hardship. Anybody could just put their mortgage in forbearance and not make payments.
Yeah, and I probably got 3-4 calls just from my buddies asking me, what should I do? I don't have to pay my mortgage for 3-4 months. I think all this money I'm going to save, and that's what I'm going to do. Can they not show me as late? You tell me, so.
There are thousands of people
if I'm hearing
that
that
have
just
done
from
that.
a few,
Strategically put their mortgage in
people.
forbearance.
Yeah.
We run across that all the time.
Yeah.
And then when they decide to refi, they then bring it current to qualify to do that, and then make 3 payments on time. So.
Mm-hmm.
Yeah, that can be a lot of money though if they waited to pay for 3 months or something.
Nobody
like that.
wants to make that lump sum payment,
no,
right?
Absolutely not. You almost think that you don't owe it.
It reminds me of the days when it reminds me back in 2008 through 2010, where people went delinquent on their mortgage. There wasn't a forbearance opportunity. We just quit making our mortgage payments, right? Mm-hmm. And then we would want to go do a mortgage modification, okay? And so the mortgage modification was, hey, my lifestyle, so to speak, or my employment has changed. I can't afford to make my current mortgage payment. I want to keep my home. How is the bank going to help me keep that home? And you would almost requalify for a mortgage, and they would say, hey, this is what we think you can afford. Mm-hmm. So we're going to adjust your mortgage payment, accordingly.
Yeah.
Well, I think in some of those cases, people remodified into balloon payments at the end. Or there was a lot of different. But what happened was, people even then, like, it took so long to get a modification. You might have not paid your mortgage for 6 months, 9 months, a year.
Yes.
Well, now, by the way, you're also in foreclosure.
Yeah.
Yep.
And
a lot of times the only way to get people out of foreclosure was for them to short sale their home because they didn't have the equity to do it, or eventually they would get that mortgage modification, mm-hmm. which would get their mortgage current, and the foreclosure proceedings would stop. But I think that's the unknown right now mm-hmm. with forbearance, is people don't know how that's going to be handled. And I think there's probably a lot of consumers out there right now who are in forbearance that they're probably not asking the right questions. Like, you need to be asking questions to your servicer as to what is this going to look like, mm-hmm. When it does come down to the point that I have to repay. Because, John, to your point, there are thousands of homeowners across the country who have mortgages that did a strategic forbearance, meaning they had the financial means to continue to make the payment. They just chose not to.
That's right. I believe that for sure.
Right.
Yeah. And right now, a lot of them are probably thinking, ones that want to refinance with all these great rates these rates are incredible now. A lot of them probably thinking, hey,
they're missing
maybe
the
it's not
opportunity.
showing the forbearance. Maybe I can get away with it. Well, like VanDyk's doing, and like most lenders are doing right now, what they're asking us to do on every single loan that's closing is we are having to verify not just every person, every mortgage trade line on every credit report to find out if it's in forbearance or not, because you want to know that before they close.
Yeah, so that's an important thing to note. So that's an agency thing, meaning it's not lender specific. It's a Fannie Mae, Freddie Mac thing. And if you currently have a mortgage, because you're able to just randomly put one in forbearance today, we have to verify that the mortgage is current. And the only way to do that is we lean on your team.
Right.
And tell us a little bit about that process.
Yeah, so like we say, before closing, and you want to do it as soon as you can, but when it comes up and you need to find this out, is you'll contact us and, hey, we need John Jones to make sure that he is not in forbearance on any of those 10 mortgage
I promise I
accounts
am not.
he does. So our team would go ahead, and we have to contact the borrower, which will be on the line with us, so you can't lie, John.
Okay.
So, and then we contact the lenders that each one that you have a mortgage with. We have to get a live person online, and they have to do it over the phone, and they let us know and tell us, yes, he's in forbearance, or if he's not, and where they stand at with the where the payments are.
So, that sounds like a pretty time-consuming process.
It is. It is.
Sarma calls the borrower. While they're on the phone, they conference in the current servicer to verify that the loan is not currently in forbearance, and then you guys report back to the lender, and we're able to close the loan. How long does that take?
Well, if your borrower's available, then we contact the lender, and usually I'd say 50% of the time it's getting better, because it was just brand new for them too. They have had no, and
Didn't
a lot
have
of their
the manpower
and
that
the
they
COVID,
would.
Probably
they were
stacked
out.
up accordingly,
Yes,
you know?
so they're pretty stacked up. But so then they're, we give them 20 minutes to get a live person on the line to give us that information, and we're doing it over and over and over because we can't even get a live person all the time.
Wow.
So it could take a time, but you need that information before you want to give anyone, a new mortgage.
Yeah, we have to, obviously, yeah.
So it's a process, but it's important. So with that forbearance, it's not just willy-nilly. Like some people think, I'm just going to save money. That's all they have in their mind.
I think the important thing for consumers to know is there will be a cost. There will be a cost to forbearance. We just don't know what it's going to be.
Right.
Just yet.
Yeah, just yet.
And the CARE Act was a good, it's still a good idea for a lot of people, lost their jobs or got cut down in pay or whatever. So, it was tough on a lot of people. So, I thought it was a great idea.
Yeah, and the bottom line with that is to get with your lender now, like Bryan said earlier, and start talking about when that's going to come to an end for you, where you stand now. Maybe you're back employed, you're able to make your payments again, get that restarted, and negotiate to add that unpaid balance to the back side of the loan, so your payments remain the same and there's no added interest to the mortgage.
Yeah.
But I think that they put it in so quickly with this COVID. I don't think they really figured out exactly.
In an effort to get it out.
Without telling all of us servicers and lenders what was going on.
Yeah, in an effort to get it out, and it needed to get out quickly. They didn't dot all the I's and cross all the T's. And I don't know. I think it was probably the right thing to do.
I agree. Yeah.
I don't think there's anything that we can't work through.
Right.
In that regard.
And the great thing now is, unlike the Great Depression we all went through in the industry back a decade ago, there's equity in property.
Yeah.
So for a lot of these folks, if they haven't resolved their situation and they do owe money and they can't negotiate back into payments, they've got equity. In many cases, we have more home equity than we've ever had in the United States. So there's an opportunity for them to sell or downsize the home.
Yeah, because I remember back in those foreclosure days that you were talking about, Bryan, people
were upside down.
People that were going to foreclose, they just quit. They're renting their house out, making money off people. Take it off, just waiting for them to come out saying you can't be in that home any longer.
Yes.
So I know someone that was doing that for like 2 years, getting rent paid to them.
There was no equity in the house, so that was how they were getting their money. But today, you can sell a home, take your $50,000, $100,000, and reestablish yourself.
Yeah. And I think, John, what you're talking about is
and keep your credit in good standing.
Yeah, there's a fear
important.
that forbearance is going to eventually lead to delinquency, and I think it will. It will just look different, and the look different, to your point, is people have equity in homes today they didn't in 2008 through 2010. So when they need to get out from underneath that mortgage, if that time comes, they'll be able to sell it. By the way, right now you could probably sell it in a weekend and have cash in hand in 30 days.
Right.
And your credit stays intact and you have some seed money to go restart, your
That's
financial future.
Yes, yep.
John, Doug, anything else that you guys want to add as we close it up here?
No, just overall, like I was saying, best thing to do is make your payments, even if it's the minimum. Just make sure your credit stays in, perfect balance. So the lates will hurt you, but just make your minimum payments and get with you on VanDyk, definitely on the mortgage scores,
Start the
mortgage
process
report.
early.
Yes, so you know where you stand and know where you need to get to. So.
Cool. Well,
Thank you, Doug.
John and I appreciate your time. Like we said at the beginning, you are a great partner for VanDyk Mortgage, and I'm sure you are for a lot of other lenders as well. Just a huge, valuable resource. I would actually say team member.
Well, thank you.
At this point, as long as we've been working together. So, to those of you watching and listening, thanks for tuning in to the Contacts to Contracts podcast with Doug Swan here from Sarma Credit Services. My co-host, Mr. John Jones. I'm Bryan Lovell. If you liked what you saw, don't forget to subscribe to this podcast or YouTube channel, and don't forget to share it. And we will see you next week for another episode of Contacts to Contracts.